we are analyzing the financial performance of two Indian IT companies, that is Tata Consultancy Services Limited (TCS) and Infosys Technologies Limited (Infosys). For this purpose, we have analyzed the financial statements from 31st March 2002 to 31st March 2011. We have based our analysis on the following parameters: the financing activities, the investing activities, the cash flows of these companies, the price to earning ratio, the price to book ratio, the return on capital employed, the return on equity, and the earnings per share. For the purpose of our analysis, we have prepared the condensed balance sheet, income statement, and cash flow statement, and the common size balance sheet and income statement for both these companies. On the background is the condensed balance sheet, income statement, and cash flow statement for Infosys. Let us see the common size balance sheet and income statement for Infosys. Let us now see the condensed balance sheet, income statement, and cash flow statement for TCS. On the background is the common size balance sheet and income statement for TCS. Let us start analyzing our first parameter, that is financing decisions. Infosys has not taken any loan during the past 10 years. The financing activities of the company mainly consist of payment of dividend and taxes on dividend. The other important item for forming part of the financing activities is proceeds from the issue of share capital on the exercise of stock options by the employees of the company. Therefore, in most of the years, that is 9 out of 10 years under consideration, the cash flow from financing activities is negative for the company. Same is the case with TCS. Major portion of the financing activity consists of payment of dividend and taxes on dividend. During the year 2004, the company had raised a bridge loan from its parent company, Tata Sons, which was repaid in the year 2005 when the company raised funds through initial public offer. The year 2004 and 2005 are the only 2 years when the company has experienced a positive cash flow from financing activities. Thereafter, the consistent payment of dividend has led to a negative cash flow from financing activities. Moving on to investment decisions. Infosys has made consistent investment in its fixed assets. The addition to fixed assets has increased consistently from the year 2002 to 2011. Similarly, Infosys has also made good investments in other securities and its subsidiaries. The investment in subsidiaries and other securities has gone up since the year 2002 by a substantial amount. The clear indication of this is also by the increased amount of interest and other dividends received by the company forming part of other income. In the case of TCS also, the company has made consistent investments in its fixed assets and other securities and non-trade securities. Due to this consistent increase in investments in fixed assets, trade and non-trade investments, the net cash flow from investing activities is negative throughout since 2005. In the year 2005, the company has acquired a business division for which it has made an investment of 2,200 crores. This was one of the largest investing decisions the company has made in the last 7 to 8 years. Moving on to cash flows. As we have seen above, the cash from financing activities and investing activities in the case of Infosys is negative for all years. However, the cash flow generated during the year is managed to be positive by the cash from operations. The company has a robust operating activities in place. The collection from debtors is very strong. As we can see from the director's report forming part of the annual report, none of the debtors are paying over 60 days. A very small marginal debtors are paying over 90 days. This shows good on the company's collection scenario. In the case of TCS, the net cash generated during the year is not very consistent. The company has generated positive cash flows from its operating activities. This positive cash flow is partly being utilized by the company in making further investments and partly in making dividend payments to the shareholders. We now move on to the price to earnings ratio. The price to earnings ratio for Infosys has been in the range of 30 times. Due to the recession in 2008, the market price of the share came down. This caused the price to earnings ratio to fall by 40%, that is from 30 times to 18 times in 2008 and to 13 times in 2009. In the case of TCS, the price to earnings ratio has been continuously falling since 2005. In the year 2008, due to the economic meltdown, the price to earnings ratio came down by 45%, that is from 32 times to 17 times, and further to 11 times in the year 2009. Even though the EPS of the company has been continuously increasing, the fall in the market price exceeded the increase in the EPS. This caused the price to earnings ratio to continuously fall. We now move to the price to book ratio. The price to book ratio compares the market price of the share of a company to the book value per share of a company. A high price to book ratio determines that the shares of a company are in good demand in the stock exchanges. In the case of Infosys and TCS, the book value of the shares of the company have been continuously increasing. However, the market price of the company have not been increasing to that extent, therefore causing the price to book ratio to continuously fall. However, during the year 2008 and 2009, due to the sudden economic slowdown, the market price of the shares of both the companies fell drastically, causing the price to book ratio to fall. Moving on to return on capital employed. The ROCE is the return on 1 rupee of equity, reserves and long-term liabilities invested in the company. The capital employed of both the companies, that is Infosys and TCS, has been increasing throughout. This is because the retained earnings of the company has been increasing. However, the PBIT has not increased in the same ratio, therefore the ROCE of both the companies have been following. However, the PBIT of TCS has increased in an inconsistent manner. Therefore, this has caused the ROCE curve of TCS to be inconsistent. Moving on to return on equity. Return on equity is the profit earned per rupee of owners' funds. The profit for this purpose is determined after meeting all external obligations of the company, including taxes. The increasing retained earnings of both the companies has caused the consistent increase in the owners' funds. This has led to the return on equity to continuously fall. In the case of Infosys, the PAT remained stagnant from 2009 to 2010. This caused the ROE to fall by 20% from 2009 to 2010. We now look at the last ratio, that is earnings per share. The real EPS for both the companies have been increasing continuously. The reported EPS has fallen in two instances respectively for both the companies. This is because at that point of time the companies had issued bonus shares in that particular year. Therefore, we can conclude that the earnings per rupee of equity invested by the investor at the beginning has continuously been rising for both the companies.